Hello, Finimizers. Welcome to another Finimize live event. Actually, I will just wait a few seconds that can join. Give it a few seconds. I see the number is going up. That's a good sign. Okay, so I will just start with the introduction, and then people can still join in a few seconds. So hello everyone, welcome to another Finimize live event. My name is Stephane, I'm your Finimize analyst, and I'm hosting today's event on peer-to-peer lending, the next opportunity, sponsored by Prosper. Big thanks to Prosper for sponsoring this event today. But first, before we start, just some very basic and quick housekeeping rules to run through. Number one, feel free to introduce yourself in the chat. Tell us where you're tuning in from. I'm tuning in from Malaga in the south of Spain. So, anyone who's in a sunnier or in a colder location, please feel free to enter this in the chat. And remember to switch to all attendees so everyone can see your messages. It's going to be a 25-minute workshop followed by a 5-minute audience Q&A. So, make sure you can use that Q&A box to ask a question. And if you see a question you like, you can upvote it so it moves to the top. And, that way we can get through the most upvoted questions first. All right, I think now people have mostly joined, so we can kick this off. Our event partner for today is Prosper. It was founded in 2005. And Prosper introduced US consumers to an innovative new approach to personal finance called peer-to-peer lending. And through Prosper, people can invest in each other in a way that is financially and socially rewarding. Borrowers apply online for a fixed rate, fixed term loan between $2,000 and $50,000, and individuals and institutions can invest in the loans and earn attractive return. Before we start, a very important disclaimer. It will be very quick. All of the views, opinions, and content expressed in this webinar are my own and do not necessarily state or reflect the views or positions of Prosper. So, nothing contained in this webinar is intended to constitute legal, tax, or investment advice, nor an opinion regarding the appropriateness of any investment, nor a solicitation of any type by Prosper. Okay, Prosper makes no representation or warranties as to the completeness, accuracy, or usefulness of any information presented. So, to put it very simply, anything I say is wrong or misleading, it's all on me. So, please don't try to trick me with your questions at the end. Okay, so today in this presentation, I'll give you an introduction to peer-to-peer lending and a few tips on how you can get started. So make sure you stay until the end. So let's dive in. So one of the biggest trends, if you look at the world of global finance over recent years, has really been the rise of private credit, and in particular, direct lending, which is a form of private credit where institutions, say, a hedge fund or a private equity firm, lends directly to businesses without the involvement of a traditional financial intermediary like a bank. So you might wonder why. Well, it's not just because it offers borrowers more flexibility, especially in times like these when lending standards are getting stricter and interest rates higher. It's also because it presents investors, the ones lending the money to these private companies, with attractive risk-adjusted returns and a sprinkle of diversification to their portfolios. And that's why it's taken such a huge importance in the world of asset management. But here comes really the exciting part for you, and for me actually too. Direct lending is also possible to retail investors like you and me. And thanks to the word of peer-to-peer lending and companies like Prosper, Kiva, Upstart, Funding Circle, and Cufflink, retail investors like you and me now have access to these sophisticated, alternative investments that were previously only reserved for institutions like hedge funds or private equity groups. And it's a pretty big trend if you look at it. So actually, let me start the slides. That was a disclaimer. Yeah. So here we are. So this really isn't just a passing trend. The peer-to-peer lending market has really been on a rocket ship trajectory, as you can see in that chart. In 2021, it was valued at about 82 billion. But if you fast forward to 2030, the project suggest it would soar to a pretty significant 804 billion. So, that's a growth rate of 30% annually. And, of course, the US almost always leads the charge, but Europe and the UK aren't too far behind, with about 200 to 50 platforms respectively. So wherever you are in, you probably have an opportunity to invest in peer-to-peer lending. So dive a little bit deeper into the world of peer-to-peer lending. So what exactly is peer-to-peer lending? Well, imagine this. Instead of heading to a bank or a traditional financial institution, you turn to everyday people to fund your needs, okay? So that's basically the essence of peer-to-peer lending. It's a system where folks like you and me can lend money to other individuals, or nonprofits with a cause, or businesses with big dreams, right? So it's not just lending to businesses, it's also lending to individuals. Now, if you're picturing, someone borrowing to buy a fancy coffee machine or a new pair of shoes, well, you have to think a little bit bigger. Here, really, we're talking about loans that can help businesses expand, or, that can help homeowners improve their property, or even just, help someone finance their healthcare needs. So it really goes beyond the kind of small, everyday kind of spending needs. But how does this all come together? And I think, that's when really the magic of online platforms like Prosper happen. These platforms, they essentially play matchmakers. They connect borrowers with potential investors, but they're not just setting up blind dates. They're doing some serious vetting first. So let me just walk you through the basic process now. So just a very important note on, each platform has its unique features. Here, I'm just describing an overall process, broad overview to just help you understand how it works at a high level. So it all starts with borrowers filling out an online application form. And, here we're not just talking about name and address kind of deal, it's all about providing detailed financial data, and sometimes even, your educational background, your work history, and even sometimes your social media presence. So I'm not sure I would have had a very strong application. Then it's all about vetting. The platforms then roll up their sleeves and they get to work. They're using a very advanced algorithm and try to assess the risk associated with each of the borrowers. So, think of it like a financial health checkup, and basically, the borrowers get a risk rating, a risk grade that will basically dictate the interest rate on their loan. Then once they're vetted, the borrowers can get listed on the platform. They can showcase, their loan amount, their purpose, and the interest rate they've been offered. And now the exciting part, the investment part. This is where most of you will want to be. The investor can basically browse these listings on the website. They can, or on the app, they can pick and choose where to put their money. And I think what is really cool at this stage is that as an investor, you can spread your investment. You can back multiple borrowers. So it's all about diversifying and managing your risk. And you can also, buy just a portion of a loan. And then, of course, once you've made the investment, comes the repayment, last stage of that overview. And once a borrower's loans get fully funded, they start repaying that loan in monthly installments. This includes both the principal amount and the interest on that loan. And as they repay, of course, the investor get their share. And usually we're talking about short-term loans, from 1 to 5 years. But of course, there are exceptions to that. So in a very at a very high level, peer-to-peer lending is really sort of revolutionizing, I think, the way we think about borrowing and investing. And it's more personal, it's more flexible, and I think for many it's a whole lot more exciting. I have to say, when I was doing the research for this webinar, I was actually really surprised at how exciting all of these spaces. So now that we've got a grasp of how peer-to-peer lending works, let's dive into the juicy bits, the benefits and the risks of peer-to-peer lending. So let's start first with the benefits. For borrowers, of course, cost and convenience are really kind of the two main benefits. One of the standout perks of peer-to-peer lending is the potential for lower borrowing rates. Peer-to-peer lending platforms, they're not like banks with those massive overheads. So, that leads to competitive interest rates, very often more attractive than rates from traditional lenders like a bank, and definitely more appealing than, those pesky credit card interest rates. And the cherry on top is really that the entire application process is online. So it's pretty swift, it's pretty easy. And sometimes those peer-to-peer companies also use a different credit scoring model than the bank. So even if a bank, for example, doesn't necessarily accept you because they're using an updated model, you might still have a shot with a peer-to-peer lending company, and they generally use a more advanced technology than banks. But this is my opinion. Speed is another big advantage, big benefit. If you think about the traditional kind of application system where you have lots of paperwork, you have to wait in a long queue with a number on your ticket. Well, forget about all of those things. With a peer-to-peer platform, basically they're using AI, machine learning, and they're making basically everything online super quick and super smooth. So it just takes a few minutes to basically fill out those kind of forms. Flexibility is very important, especially for smaller loans. Not everyone needs a six-figure loan. If you seek a small amount, a peer-to-peer platform is really a godsend, to be honest, because it can accommodate your needs much more easily than a traditional bank would, because they would most likely kind of overlook these smaller loans. And now the part that will interest you most. Here you can see the benefit for investors. Okay, so the first benefit, maybe one of the biggest one, of course, is that it provides attractive returns. Peer-to-peer lending, it really offers the opportunity for higher returns compared to traditional bond investments or cash. I think, if I'm not mistaken, but again, don't take my word for it, but I think the average historical return for loans, it was about 5.7% historically, and you could have made much more than that depending on the type of loan you invested. And of course, that was during a period where interest rates were extremely low. So if you're looking at your prospective returns today with higher interest rates, you're probably looking at returns than that. So I think a high potential return is definitely something that makes peer-to-peer lending very attractive. But it's not just any return. It's really a passive income if you think about it. It's really you actually pocketing the interest from your loans while you sleep, essentially. So I think this is something that can be extremely attractive for investors. Diversification can also be a pretty strong pro of peer-to-peer lending. An asset class than bonds and stocks. It's influenced by different factors, and so hopefully it will provide you with your diversification benefits. And lastly, a strong is that it requires only a low initial investment. You don't need to break the bank to start investing. Many platforms let you invest so you can invest even if you have very limited fund. I think Prosper, for example, you can start at just $25 to invest. Now, of course, those were all of the benefits. Now let's look at the risks. So for borrowers, one of the risks is if you're of course you have to brace yourself for potentially higher interest. And of course, fees. Just like traditional banks, some peer-to-peer platforms might charge fees. So you always have to read the fine print if you're a borrower and you want to access peer. Now, for investors, risk of default, is a risk. Here's the hard truth: some borrowers will default. It's part of the lending game. That's just as it is. But ideally, the interest that you receive from all of those other successful should cover for those losses, and over the long term, you should end up making money. But remember, of course, that there's no guarantee. But that's the kind of idea, and why you should diversify. And while of course we're talking about the risk, and while peer-to-peer platforms generally have acceptable default, also it's important to remember that if there is a recession, you could potentially face more defaults, right? If you think back in 2008, banks faced mass defaults all at the same time. It doesn't mean it will happen again, but in a future recession, if it's really bad, it could also happen to you, where you basically have to bear the brunt of those losses. But again, you have to think about the long term. Limited information is another risk. You're making decisions based on the data provided by the platform. But of course, you don't have the full insight into a borrower's full profile. So, there's always a risk that, you're missing something. Market and regulation is also a risk. The peer-to-peer lending industry is still relatively new, and it's constantly evolving. And changes in regulation or market shifts can potentially impact platforms' operations or borrowers or investors. Liquidity is something you have to be mindful of, because once you've lent your money, it's out. Just snap your fingers and get it back. So you always have to assume that your invested money is locked in, basically, in the platform until the loan term ends. It can be time-consuming, managing a diverse portfolio of small investments. So, you just have to be prepared, basically, to not just invest your money, but also your time. And of course, another potential risk is that diversification doesn't always work. Once again, in an economic downturn, potentially you might face multiple losses. Let's say now you're intrigued by peer-to-peer lending, and you're considering those in, and I think, to be honest, I think you should, because as with any investment, again, we've seen all of the benefits of peer-to-peer lending. It can add diversification to your portfolio. It's a different asset class. It allows you to earn some passive income. It allows you to potentially get attractive returns. So, now what we're going to do in the next few minutes is to basically go through a sort of case study to make it a little bit more practical, help you how to choose basically the right platform, and what you need to do when you make an investment. Okay, so how to select a platform. So I think there are a couple of things that you need to be looking at. First, what types of loans do they offer? Are they lending to individual or businesses, or both? Are the loans secured against assets or properties? Different loans come with different risk levels, so it's extremely important that you understand the types of loans that the platform offers. How much information the platform provide on borrowers? Some platforms will give you a deep dive into borrower data, while others might be more, surface level. So some might, for example, provide FICO scores, other not. So the more you know, generally, better. How much will it cost me, right? So charge fees to investors, like for example, a 1% cut for new investments. So that's something that you want to look at as well. What's the quoted returns rate? So look at the interest rates that the different platforms advertise. Does it factor in potential default? What were past default rates for similar borrowers? And make sure that the platform's estimated default rate align with reality. Make sure you compare across the different platforms. Can you choose your risk level? Some platforms will allow you to pick a level of risk you're comfortable with, and you can spread your investment over a portfolio of loans in your chosen risk category, and that can be potentially helpful, for example, if you're a bit more risk averse. But of course, it can also result in slightly lower returns. But it's important to check whether you can choose your risk level. Is the lending diversified by default, or do I get to pick borrowers? Some platforms will spread your investment across multiple borrowers by default. Others will let you handpick the borrowers yourself, and so you can really craft the portfolio the way you want. But of course, while that gives you more control, it also kind of demands a higher confidence in your ability to assess the borrower. It's something that you need to check when you select the platform. Then when you dive into the platform's borrower acceptance criteria, it's super important to check whether basically they have a strict vetting process, or basically free for all and just anyone is accepted. And lastly, are they regulated? That being said, don't blindly place your trust in regulations. Your money might be gone forever, even technically as you're back. And there are also trade bodies that import their members, and you probably want to go with a platform that's in one. So overall, to summarize, how you should select the platform, I would say, make sure you really understand the different products, the different terms that are available on the platform, and make sure you select one that's reputable, that's transparent, that's well managed, and really that offers fits your risk tolerance and your return objectives. Okay, how to assess a borrower. So, that's one of the trickiest part of peer-to-peer lending, deciding who to lend to. Remember that, there are billion-dollar companies like Experian built solely to assess lending risk. So, it's not a walk in the park. But, if you're up for the challenge, here are some kind of pointers to guide you. So I think number one is, to ask yourself how diversified you are. If you're handpicking a different, diversification is even more important than, if you just invest across an already diversified pool of borrowers. So, avoid putting all your eggs in one basket. Lending to just one borrower is a bit playing like financial Russian roulette. So, instead, my recommendation is to spread your investment across multiple loans. It might require a bit more effort or time, but I think it's really worth the extra time. The initial investment can be quite small. It's something that, you can definitely do. You won't need to invest $1,000 every time. You can invest as little as 25 in some cases. Secondly, is the loan secure? Some loans come with collateral, like a house or a car. These are secured loans, and they sort of offer a safety net in case things go south. On the other hand, unsecured loans don't have discussion, but the thing about these unsecured loans, of course, is that they give you a higher returns. But in any case, if you're thinking about investing in a particular borrower, in a particular loan, make sure you check whether it's secure or not. If you lend to a business, you have to also make sure that you know what kind of business this is. Some of them are a lot more risky, much less risky, some are more cyclical, some less cyclical. So, make sure you do your homework. Now, lastly, the risk versus the reward. After you assess the different risk, you always have to ask yourself, is the potential reward worth the risk? If you're taking on more risk, you naturally expect higher returns. But what's high for you, that it's really only you can decide. So it's generally a good idea to compare the sort of different rates that you can get across a different platform to get a sense of what's fair for a particular risk of a loan. Now, how to invest safely? So, you've probably noticed that the interest rates in peer-to-peer lending often dwarf those of traditional savings account. You can earn much higher interest rates investing in peer-to-peer lending. Remember, with greater rewards come greater risk. So, let's just dive into how you can potentially navigate these waters a little bit more safely. So I think my first tip to you would be to define a budget in advance and stick to it. Like all investments, it comes with a set of risks. So be actually commit any capital, decide sort of what's your budget. So how much of your overall wealth you're willing to invest in peer-to-peer. I would say it's probably sensible to make it, not a huge part of your overall investment portfolio. You should also own stocks, bonds, index funds, these kind of things. But, decide part of your portfolio, what's a good allocation to peer-to-peer lending, if you think that is a good idea. So, that budget in advance, and then try to stick to it. I would say, a bad strategy is, for example, if it works really bad and you try to double down, or or then you change your mind and you decide to change it. No, try to define it in advance and try to stick to it. My second tip is diversification is really your best friend. You really have to diversify not just across different loans, but potentially also across platforms. Each platform has a different risk assessment method and borrower type. So if you spread your investment across different platforms, you're probably, cushioning yourself against potential pitfalls. And I think it also makes sense to find some diversification with what you're already invested in. So, for example, if you're living in Dublin and you're already sort of invested in Irish property, and you at the same time, you want to, you see on the peer-to-peer platform that you could potentially fund some apartment construction in Dublin through peer-to-peer lending, then that's probably not a great idea because you already have a lot of exposure in your portfolio. So try to find something that is a bit more diversifying. Third is to brace for defaults. It's an unfortunate reality of lending. Some borrowers will default. So, always factor that in when you calculate your expected returns, and also, just make sure you're expecting this. It's like if you're an insurance company, you have, your pool of clients, that you will have to pay some claims, but on average, across a sufficiently broad number of people, you expect a positive return, but some will default. It's just part of the game. I mean, it doesn't happen that much, to be very honest. It's a very minority, but it's still important. If you invest for long enough, it's very likely that you will be faced with some defaults. Keep tabs on your investment, regularly monitor them, stay updated on the borrower repayment, on the platform news, and any changes in the loan terms. Lastly, research is king. Knowledge is power. The more you know about peer-to-peer lending and the platforms you're considering, the better equipped you'll be to make informed decisions. So, use the criteria we've discussed today to evaluate different platforms, dive deep, ask questions, and, always prioritize understanding over taste. So, that's it for the kind of educational part. I would just say to conclude that, what I love personally most about peer-to-peer lending is that it's not just a theoretical concept. It has tangible, real-world implications, and there are countless success stories of individuals and businesses that have achieved their dreams thanks to peer-to-peer loans. And what I also find super exciting is that peer-to-peer lending is really sort of a testament to how technology can transform, age-old practices, like the way banks make loans, and it's making this process more efficient, more inclusive, and really user-centric. So I think that's also something that I just wanted to say. And of course, I think it's a fantastic opportunity. Of course, you need to understand the risk. It's really important, but it's not different than any other investment. You always have to know your objectives, know your risk tolerance, have a plan, stick to it, understand the risks. And I think in this climate, peer-to-peer lending can actually be quite an interesting opportunity for some of you, and potentially an attractive addition to your portfolio. So my advice: start small, get comfortable with the overall process, and that way you can gradually build your peer-to-peer portfolio. So now it's time to turn this over to you and asking what questions you have for me. Don't forget, you can upvote the questions if you're interested in, you can upvote the different questions. So let me just open that. Can you recommend any places to do more research for those who are new to peer-to-peer lending? Yes, I mean, if you start Googling, you will find pretty quickly some more information. Of course, it's today's sponsor, but I actually started reading Prosper's guide to peer-to-peer lending, which you can easily find on their website, or if you just Google it, which I found pretty valuable and a very good first overview of it. So check those websites. I think you won't find it too difficult to find kind of introductory information on peer-to-peer lending. So hopefully it's just a few clicks away. How do you recommend alternative assets like peer-to-peer fit into a broader portfolio? A specific percentage? So I cannot give a recommendation, and not just because this wouldn't be something that would be okay with compliance, but also because it really depends not just on your return objectives, but also on your risk tolerance and on your specific needs. So for example, if you have liquidity needs, if you need the money, I would say allocate a small portion to it, because your money will be locked for a few years. So if you need the liquidity, don't allocate all of your portfolio into peer-to-peer lending. Now, if you don't have the liquidity need, it also depends on your return objectives and all of these kind of things. So honestly, I couldn't give you a specific answer, a specific percentage for that one. That being said, you can have a look, for example, on the BlackRock website. They have kind of examples of portfolios for different types of investors, and they give kind of recommended percent allocations, and you can have a look at how much they recommend for alternative assets. But just keep in mind, this is just one way of looking at it, and it's just their opinion. So you have to really make sure that it fits your own objectives, risk tolerance, and any particular circumstances like liquidity needs and these kind of things. Who decides the rates and or all repayments due at the end of term, or returns repayments can be staggered? So who decides the rates? Well, it's ultimately, and again, so, it depends. I'm definitely not an expert on peer-to-peer lending, but I think it's on the platform, through these algorithms that will kind of identify the risk, etc. So I think, that's for the rates part. In terms of the repayments, so generally it's kind of monthly repayments from what I've seen. So it is staggered across the life of the loan. It tends to be between 1 year to 5 years. So it tends to be monthly payments. Is it better to use auto invest or to select loans on my own? Well, once again, I think it depends on sort of your ability to assess individual borrowers. I think if you think you've got the skills, you can try, but I think generally auto invest is probably a good default option for most of you. But then you always have the option, if you think you're an expert and you have the ability to do this, to select loans on your own, or perhaps you even want to just loan money to people in same circumstances as you. That's also another option. I think there's also this kind of social element to peer-to-peer lending. Maybe you find someone who wants to get a loan, and you identify with that person and you want to help him or her out, and you want to give a loan to that person. So that's another option. So unfortunately, all the time we have for today. So I think there is another event with Prosperity where we're going to cover a kind of alternative investments more generally. So I think back on your question on how much % should you allocate to your lending, definitely check in again in January, because that's something that we might cover in that webinar. So make sure you keep that in your calendar, and hopefully we'll see you in January. Thanks again for joining us, and hopefully it's been informative for you. So take care and have a great evening. Bye-bye.